Hi believers, this is Amit from our team, and I'm here to provide a weekly bite and the road ahead in the markets. It was a significant week for the Indian markets, with the Indian government finally announcing the much awaited GST reforms. After the income tax reduction, this GST rate rationalization exercise is one of the biggest reforms taken by the government this year. Equity benchmark snapped the 2 week losing streak and closed at 24,741, the Nifty, with a weekly gain of 1%. Despite an initial surge following GST rate rationalization announcement, markets witnessed profit booking from the higher levels. Nifty midcap and small cap relatively outperformed the benchmark by gaining 2.5% each. Sectorally, barring IT and realty, all indices closed in green, where auto, metals, and consumer durables were the major outperformers. In any other market, this announcement itself would have been enough to start a new rally. But we are in a choppy consolidating market with a stagnant earning growth till now, which means such a significant announcement had no impact on the main indices at all. To put things in perspective, on 20th September 2019, the Government of India slashed corporate tax rate base cut from 30% to 22% for domestic firms and 25% to 15% for the new manufacturing companies. At that time, the market reaction was explosive. Nifty 50 jumped 5.3% on the same day, its biggest single day rally in over a decade. Over the next two sessions of Nifty, it surged 8% total, led by banks, autos, and industrials. With current GST rate rationalization, Nifty barely managed to end the week in positive, mainly due to doubts on the corporate earnings. Apart from GST rate rationalization, another significant event took place this week was FI's ownership of Indian equities reached its 13-year low. The third big event that took place this week was gold reaching its new all-time high. This brings gold year-to-date returns of around 35%, outperforming both Nifty and S&P by a huge margin. Until recently, the main driver of gold was central bank purchases, particularly China, who has been dumping its holding of US treasuries and increasing holding of gold as part of its reserves. After China, other countries, including those from BRICS, are also ramping up their gold reserves. Russia, India, China official gold reserves are now 4 times larger than during the 2008 crisis. Foreign banks now hold more gold in reserves than US treasuries for the first time since 1996. Apart from central bank buying, the other key driver of gold recently is the deteriorating stance of the US economy. The US jobs and inflation data both combined increasingly point towards stagflation. The US unemployment rate breached 4.3% this week, its highest since the pandemic, while inflation in the US continues to remain high at 2.7% even before accounting the impact of tariff. The US Fed is now behind the curve and will have to implement emergency rate cuts. How much behind the curve will depend on whether they cut 25 bips or 50 bips at the next FOMC meeting on 17th of September. Along with rising inflation, US manufacturing activity continues to shrink. This is bad economic data, and hence the investors are pushing their investment towards safe assets like gold. If the US economy further deteriorates, expect more money flowing towards gold. In our markets, on technical front, the weekly price action formed an insider bar carrying higher low, indicating pause in the downward momentum for now. This is actually a good news, guys. Key point to highlight is Nifty 50 reclaimed 100-day moving average, suggesting a potential pause in the prolonged corrective phase and scope for trend reversal. Going ahead, strong support is placed on the vicinity of 24,200, which is 200-day moving average, which indicates a high probability of demand emerging at the lower levels and continuation of the primary uptrend and a move towards 25,000. Unfortunately, 25,000 is acting as a big resistance. Once we cross 25,000, bull will take over. The current consolidation phase presents opportunities to accumulate quality stocks backed by strong earnings, particularly those poised to benefit from next generation GST reforms and upcoming festive season. Structurally, auto index witnessed a strong breakout from the weekly inverse head and shoulder formation, supported by GST reforms. The breakout signal continuation of momentum with scope to retest its all-time high with a 10% upside potential in the next couple of quarters. We like an ancillary company called Precall. It is a safe bet according to us, but please do your own research. On the market breadth, the percentage of stocks above 50-day moving average has bounced from the oversold zone of 25% last week and improved where it is currently placed at 40%, offering incremental buying opportunity, which means that people are buying more stocks right now, and that's why it went from 25% to 40%. On the broader market level, both Nifty and small cap has been trading in the vicinity of 52-week moving average, which has been held since April 2025, offering an incremental buying opportunity. Let's conclude over here with certain points. The market this week was clear in its message. Indian market needs earning growth to come back. Even big bang reforms aren't enough to ignite it with flat earnings. US economic condition is worsening and full impact of tariff on job growth and inflation will be visible in next few months. Hence, I think Trump needs to tighten its belt. Market has started moving to safe assets like gold in expectation of recession in US. We should put money only in quality companies. Unlike post-COVID years where anything and everything ran and investors made money. That rosy time is over. That's all for today. Wishing you a profitable trading week ahead. Thank you.